Prateek Parekh, Director, Equity Strategist at Nuvama Institutional Equities, joins in with what he made of India Inc. in this quarter. Morning, Prateek. Thanks for joining in. Prateek, for start with what your expectations were from the first quarter of this financial year and how well has India Inc. fared?
Yeah, thanks, Amita, for having me over. It's always a pleasure being on the show. I think if you look at Q1, right, Q1 is quite different from what we had in FY24. FY24 was a very unique year, which was plagued with large amount of divergences and heterogeneities. For example, in FY24, we had BSE 500 top line growth growing by 8%, but profit growth grew by 20%. You had within top line as well large divergence between consumption and capex oriented names or cyclicals. Like FMCG companies saw low single digit growth, top line growth, whereas cyclicals like autos and industrials saw very high teens growth. I think those divergences are now reconciling. In Q1, we have seen a lot more homogeneity in variables. This is a quarter where top line and profit growth have reconciled. Top line growth remains stuck at 8%. Profit growth, which was in very high teens or 20% for last year, has slowed down to 10%. And going ahead as well, we expect this reconciliation to continue. Further, within top line as well, you have had reconciliation between cyclical top line as well as that of defensives. So in some sense, if I have to summarize the quarter one in one way, it is reconciliation of divergences that we had in FY24. And going ahead, top line will be the key monitorable variable that will dictate the earnings outlook per se, Samita.
Right. Prateek, that of course was on a larger sort of, the universe in terms of what you made of the earnings. And from what I take away, you seem to be fairly impressed. Profits have outpaced your growth, has far outpaced revenue growth. Now, while profit has grown significantly for a lot of companies, it's coming on back of or on the heels of operational efficiency. If revenue growth is not keeping pace, are you concerned? Do you feel like the profit uptick, while looks good, may not be organic and may not be sustainable then for the rest of the financial year?
Yeah, that's absolutely right, Samita. In fact, entire post-COVID earnings, if you look at it, is been a function of margins or operational efficiency. Further, within margins, you've had big tailwinds coming from banking sector credit costs, which were very depressed, which have gone down to very low levels. From here on, I think those tailwinds are behind us. Input prices are largely stable on a YY basis. Banking sector credit costs, have seemed to have bottomed out, and whatever the commentary is, seems like there's going to be marginal upside risk rather than downside risk. And finally, operational efficiencies on the working capital improvement, and a lot of that has been extracted. From here on, I think for whatever profit growth will be dependent on demand, and there, unfortunately, the outlook is not seeming to be very great. Despite deflation going away, top line is not moving higher. Top line growth remains stuck in single digits for the fifth straight quarter, and this is not good news. And that is where I think for FY25, there are more downside risks to earnings than upside, because consensus is still forecasting mid-teens earnings growth. And if top line growth remains in single digits, it's difficult to see, how that earnings growth number can be delivered. So to that extent, yes, FY25 will be a bit more challenging year in terms of earnings, because your operational efficiencies have been extracted and demand continues to remain subpar versus Samita.
So, Prateek, good morning, Neeraj here. Your overweight on private banks, is it a factor of any green shoots or good signals that you saw in quarter one? Or is it based on a hypothesis that credit growth at some point of time will pick up because of capex or otherwise?
Yeah, that's a good question, Neeraj. See, I think what has happened last year has been very unique. Last year, if you look at it, generally private banks tend to outperform when there's a cyclical meltdown. Last year is probably the only year in last 20 years where you had cyclicals like industrials, autos, even metals, significantly outperforming and rising, but private banks actually underperforming. And our view has been that, margin pressures have been quite high. Going ahead, our overweight on private banks is a function of three variables. First, we think that margins are likely to bottom out, while credit growth will slow, but I think margins could most likely bottom out. Second, we expect earnings growth of broader market to moderate. So the earnings differential between private banks and rest of them is going to narrow meaningfully, and that process has already begun. And third, in the entire market, this is the only space where we find valuations quite reasonable on an absolute basis. So, keeping these three factors in mind is why we are overweight private banks, despite our cautious view on the demand and on the overall earnings per se, Neeraj.
Okay, okay, so that's fair. Now, I just want to understand what surprised you, Prateek, this quarter. I mean, it could be on the downside, it could be on the upside, but maybe it's a pocket, maybe there are specific stocks. I'm not asking for recommendations. But where did earnings really surprise you? Or maybe commentary really surprise you?
So I think earnings were on the downside. The surprise has been on the cyclicals part. Now, some of it is associated with elections and heat waves, but I think in general, some of the high-end consumption that is slowing down, I think that's a negative surprise if you ask me in this quarter. For example, luxury hotel space or the industrial space or even the autos SUV space where growth is clearly tapering down, I think that's a negative surprise. The view was that this momentum should contain and hopefully rest of them should improve. On the positive front, on the commentary, where we think there is scope of improvement is on two aspects. One is, I think, the durables consumption that I think seems to be coming back after a big pain for quite some time, and that has been a very big positive surprise in this quarter. And second is, I think, on the lower end consumption as well. The FMCG or even the IT part of it, which has been a big pain point until now, I think their signs of stability are clearly visible. And that I think is also a positive surprise of sorts per se, Neeraj. So I think overall, my main point is FY24's, the leaders or stars, I think their negative surprises have begun. And FY24's laggards, which is like say FMCG and IT, there I think at the margin, signs of bottoming out are visible. And if anything, there are more positive surprises than negative surprises per se, Neeraj.
Very lastly, two sectors. One is IT. We did talk to a few managements, and I'm sure you talked to even more, where there was an indication that they are seeing green shoots. Now, you also have the much anticipated US elections, which usually brings with it, post the event, of course, some sort of clarity in terms of orders for the IT sector. What is the outlook and what do you make of the earnings and what do you anticipate for the sector going ahead? And talking about green shoots, the other one is rural consumption, which we've seen a bit of an uptick in terms of reporting this quarter. Taking a cue from what we've seen and the commentary of management, how would you approach both these sectors in terms of earnings expectations for Q2?
Yeah. So I think for IT clearly, I feel last year was a very painful year. In fact, the dollar revenue growth or CC growth that we've seen in IT in FY24 is probably one of the lowest on record. It almost feels like recession was felt by these companies. Our view on IT is that the earnings downgrade cycle is largely behind us. Now, the improvement and the reason for that is twofold. One, on the demand part, we clearly feel that the IT demand has bottomed out. How much it will improve and the pace and the quantum of improvement, I think that remains uncertain. But where we still believe that the earnings downward cycle has ended, I think, is on the margins part. I mean, these companies are having very low attritions and they're able to protect margins even at very low top line growth. That's a clear sign that companies have already moved ahead of the downturn, and as and when recovery comes in, there will be operating leverage. But from a broader perspective, earnings expectations are not running very high in the space. Obviously, the recovery is not going to be linear, and there are still uncertainties on the anvil. But I think on a relative basis, I think IT clearly is one of the spaces where we feel the earnings downside risk is much more limited going ahead. Second, I think is on the FMCG and the rural recovery. Yes, that is again a spot where we expect things to improve, and our expectation is premised on two factors. One is statistical base effects have been very low, so to that extent, clearly things should bottom out. And second is seems to be clearly a shift in spending pattern of the government. If you look at not only the central government, but many state governments have given cash transfers of sorts. Like Maharashtra has announced a big cash transfer. Similarly, we expect state governments, to focus a lot more on transfers rather than necessarily capex, and this in turn should probably help support consumption at the lower end per se, Samita. So I think from both these factors, we feel for FMCG as well, the worst is behind. Recovery is there, but again, pace and the quantum is not yet very certain. But nonetheless, directionally, it is headed for the better days going ahead versus Samita.
Thank you, Prateek. It's good to get some perspective on how Q1 has been and what the outlook for Q2 is.